You'll fail as a fund manager if you think raising capital is all about the pitch. Discover the real secrets to scaling from 600,000 to 900 million while protecting your reputation and your investors. So if you want to avoid the biggest mistakes in private credit, then this episode's for you. All this and more coming right now. Here we go. Steve, welcome to the show, man.
Thanks for having me on the show, Ryan, and congratulations on the success. Happy to be here.
Yeah, it's great to have you, man. Let's jump right into it. What would you say are some of the common missteps that emerging managers make, and what would you say that they can do to avoid some of that stuff?
Yeah, I think going out and trying to sell to the masses is a big mistake for people that are setting up and scaling a MIC today. Try not to be the solution for everybody and every problem. Be clear on who you are and who you're not, and also just forget the pitch. Listen to what it is that your customers are looking for, what it is that they want, and find out what that common problem is, and try to focus on that. Try to focus on the solution there.
Awesome. So going out, trying to sell, got to raise, get this deal done. I get it. I get the vibe. I get the temptation. But I think what you're saying is that can get you swept away into areas that maybe you didn't intend on being. Is that what we're saying here?
Yeah, absolutely.
Yeah. And that's what you were saying about, for a minute, do a lot of listening. And that's something that you're really good at, is do a lot of listening. Make sure that you clearly understand the problem that your potential investors are having and how you fit in as a solution architect for that.
Yeah. And I think the other thing too, Ryan, is don't be too quick to always look for the transaction. Establish trust, develop a reputation, develop some respect, and gain that trust from your investor and from your clients first. And the deal will come, and the capital will come from there.
That's right. My philosophy, I know you've been following the show for a while, and because you told me about it when we first met, was the 3 R's: reputation, relationships, and results. And when you're doing a great listener outside of business, this is just as a human being, for heaven's sakes. If you're a great listener and you really understand, especially someone who's sought after like yourself for advice and deal advice and financing, listening is a value add. I absolutely love that. And that strengthens relationships. At least it does in my marriage. Turns out when I listen to what my wife has to say, it tends to go well. So, but in all seriousness, focusing on that and really making sure that you do a listening tour. Sometimes I call that a roadshow, but just really understanding what is it that people are looking for, what gets their blood pumping, and how do I fit in that, or how do I not? And I make a referral. And that's where the relationships come in handy. You say, that's not really what I do, but I got a friend, Steve. He does private credit. He's huge. Let me introduce you to him. I guarantee you're going to be delighted, right?
Yeah. And I think too, the average, the investors that are out there in the market today, they're constantly being pitched, and it's the old, pound the square peg through the round hole approach. And investors, they want solutions, and they want someone that's really understanding what their issues are, what it is that they're trying to accomplish, and really trying to understand how best to get them there. So again, it all comes back to listening and understanding.
Yeah, I love that. And that probably I'd love for you to unpack this a little bit, but talk about PHL's growth from your first $600,000 starter fund to this 900 million plus AUM. What were some of those capital strategies and disciplines that underpinned that ascent? Yeah,
good question. I think when we started, it was really difficult to have that discipline out of the gate. So we learned a lot of lessons early on, which hopefully listening to shows like this and podcasts like this and your guests, will help some of the listeners overcome some of that quickly. But really establishing yourself with the right stakeholders and getting alignment with people in the industry. I know when we first started, we had made great efforts to make sure that we had good connections with bankers, with accountants, lawyers, and really establishing yourselves with industry leaders and people that would provide some mentorship. I thought that was really helpful for us in terms of how we got started. And from there, learning the lessons of not trying to use the shotgun approach to investors and really focusing on those that we had alignment with in terms of what products we were offering and solutions we were providing to those investors. So taking more of a sniper approach versus the shotgun approach and being everything to everybody. We got away from that. So that was a big one. So leveraging relationships, obviously investing. We had to invest a lot of our own money. So people want to make sure that you're invested in what it is that you're doing. That was really important. And then of course, establishing that track record. I think one of the things we failed to understand was being patient. And I know everybody wants to grow and scale quickly. And I'm certain that most of the people and guests on your shows and will, they'll share that, things don't happen overnight in a lot of cases. Well, maybe they do after you're established, But when you're getting started, be patient with the process. And over time, with track record, again, reputation, respect, and you've established a foundation of trust, that's where you start to see that kind of inflection point in that scaling that happens that everybody's hoping for. So,
how important was building an advisory board in the early days? Walk me through a little bit of that.
Yeah, the advisory board was huge. I mean, it's kind of the chicken and the egg scenario, Ryan. You're especially if you're a younger person trying to set up this fund. How do you gain trust when you're getting started and you've only got a little amount of capital? Leverage those that are around you. I mean, I've been very blessed in my career, having some great people from a variety of different backgrounds, whether it was real estate, banking, credit, finance, legal, corporate finance, people that were older than me that were always happy to help. One of the cool things about this business and also in this industry is how many people are willing to give their time and help others, especially those that have been successful. I find that some of the people that are the most successful, as long as you're being respectful of their time, they're happy to give back and really help people get a leg up. And they're not protectionist. I really do feel that people want to help others. And I know certainly that's something that you're huge on. Your show's huge on that. One of the things I was thinking about, boy, I wish this podcast existed 20 years ago when I got started. That would certainly have been helpful. But anyways, here we are today. But I think when you talked about the advisory board, that was a quick way to leverage. I should say a quick way. It was a helpful tool in leveraging the experience and the trust that those people had built within their networks that rubs off on you. So by having those people surrounded by you, or you're surrounded by those folks, really does give you some early credibility that you need. You need that nudge to really build that trust with new investors, and having people like that around you that are established, have track record, have had good careers, and vouching for you as a business person and also as an individual, as a real person. You and I talked about this, how important relationships are. So the fact that you've already got those relationships with some key people, that's a tremendous amount of leverage to get started in this business. So I couldn't stress, if I was going to stress one point today, is surround yourself with a good advisory board. Yeah.
Agreed. I see it as it's one of those key things that when you have that in place, when you have an advisory board in place, what I believe is that when you're pitching investors, they understand the aggregate of the experience of the eyeballs that are on their capital. And so when you're able to do that, and it's not just this, it's not a tactic, folks. It's for your benefit. This is the way I see it, is to say, like you said, people have had great careers that can give you the insight and turn decades into days, right? There are 40, 50 years maybe at sometimes that they can bring that and bring you up to speed that cuts right through the noise, gets right to the signal. And so now you're more effective just by having them advise you. I love that.
I mean, obviously we're talking about, growing and scaling a business, but also just managing risk and that experience that they're bringing to the table about, some of the folks I know that I've surrounded myself have been hugely helpful in us avoiding large pitfalls over the last 20 years of our business. And, very, very thankful to have that knowledge and experience that they could share with us that maybe wasn't as clear in the fog of, whatever point in the business cycle that we were at. So that was also a huge benefit of the advisory board. It's not only how to improve as a business, but also how to protect the business that you already created. So that was a huge asset.
Brilliant, man. And I'm totally sold. And I know that's a big part of scaling. So, speaking of scaling, how do you recommend people balance aggressive AUM growth with investor capital preservation? So really what I'm asking is, where do we turn that risk dial to say, yeah, we want to grow, but we also want to preserve and protect the capital and the trust that current investors have given you? How do you balance that?
Yeah, this has been a question that we've dealt with our investors for we've been in business for almost 20 years now, is how big will PHL get? How long will you guys continue to grow? And do you have enough opportunity to deploy the capital? And one thing that we absolutely will not go against what we've promised our investors, and that is we're not going to take undue risk for the sake of growth. We've promised our investors a certain risk profile in terms of what their invested dollars and hard-earned dollars are being invested into, and we won't change that. In fact, along the way, we had some other opportunities in a different segment of the business, which I would consider a different risk profile. What we did actually was create a new fund that aligned with that risk profile. So there's different ways to approach that. So we've had aggregate fund growth and with different risk profiles. So we've been very, very true to our investors in each fund that we have in terms of what the risk profile is, what the target yield is within those funds, and we continue to stay true to what we've promised our investors. It's one thing we won't turn back on is our word and what we've promised to our investors.
Yeah, absolutely. That goes back to reputation, man. I love that. And how do banks play into that growth versus capital preservation? Where do they fit into all this?
Yeah, I think the banks have been hugely helpful for us, although challenging out of the gate. It's funny. I mean, before I started my funds, I was in senior banking roles in Canada here, and early on, despite having the background in banking, it was very challenging. In fact, we almost had to beg one of our Canadian banks at the time for a small loan. That was almost 17 years ago. That bank had lent us $750,000, and that bank is still part of our syndication today, which is an 8-bank syndication with almost $350 million of credit available to us. And my partner and I are hugely loyal people. And but the other part about the banks and why they've been so useful is, one, obviously we utilize some level of leverage, but we also talk about the trust and the reputation that we've established over the years with our investors. The banks have helped shine some light on that, in the sense that we've got 8 banks that have review our financials and what we do every year on an annual basis, and that gives some more accreditation and credit to what it is that we're doing. If 8 largest banks in Canada are suggesting that we're creditworthy for $350 million, I definitely give some more comfort to some of our investors to know that their hunch is right, that we are worthy of that trust. So it's played it's been a 2-pronged approach, actually, in terms of establishing those relationships. One is the credit piece of it, and then the other is just verifying that credibility.
So I'd love to go a little bit deeper on that. So we've talked about going from your $600,000, I call it the prudent fund, to the 900 million AUM plus, and you're still growing. This is amazing to watch. Then we go into, where do we turn the dial on risk? And so I want to go even a third layer deeper. A lot of what you do, I assume, has to do with underwriting, where we talk about that risk dial, right? This is where you really start to get a sense of the deal in your underwriting. What are some of those core underwriting principles that set PHL apart, both in your residential and large scale commercial land financing?
I mean, first off, the fundamentals are, we lend against quality real estate with values that we clearly understand, in markets that we clearly understand, with borrowers that have obviously an established track record and a probable exit. Those are obviously key, and every lender is going to say that. But one of the, it's funny, one of the key things that set us apart is we're still one of the very few lenders that still use common sense today. And common sense isn't all that common anymore. We talked about this earlier, Ryan. And I think that's one thing the Canadian financial institution has gotten away from. They continue to compound with policies, procedures, and regulation, which obviously are required for consumer protection. But at the end of the day, there's a consumer at the end of this, and a customer that needs a solution for what it is that what they're trying to accomplish, whether it's investing in their business, buying a home, buying an apartment building, doing a real estate development. So really finding just common sense solutions from a banking perspective and lending perspective that we've been able to provide to our customers. It's just the banks aren't providing for everybody. There's a large and growing segment that requires alternative solutions to what the Canadian financial system is providing today.
Got it. One of the things you got me really excited, when we first met, you were telling me how you have these investor nights, and you have these times where they can ask you questions. You invite auditors, bankers, everybody to do a Q&A. And I'm curious, because not a lot of people do that. How has that culture of transparency reshaped the investor trust or even capital sources?
Yeah, that's an interesting story, Ryan. What we thought was really, when we started this, and I think we started this about year 3, and I don't even know if we had 30 investors at that point in time. We were under $1 million in assets under management. It was a tiny fund at that time, and it was more so just to get together to break bread, give everybody an update on how we were doing, and just to touch base with our investors. And that evolved into an event that we host annually for all of our funds now, which we still have a waiting list almost as large as the list. We're finding it difficult to find venues big enough now to allow all of our investors to attend. But we've got north of 500 of our investors show up every annual investor meeting, and it's there that we have again our bankers, our investors, our bankers, our auditors, many of our appraisers, our corporate finance lawyers, our conveyance lawyers, anyone that's a stakeholder in our business. And it's a really fun evening because you talk about transparency and trust. Well, we don't have any seating arrangements at our events. You can sit wherever you want. You can sit beside our auditor, and it's really great because people really have the opportunity to talk I'm not controlling the conversation, and it's great. And I think a lot of investors, the older investors love it. It's a great event. And the new investors really love it because they get to see what our business is all about, and talk about establishing that trust. It's a huge step up. And I know I would say some of our competition has been trying to copy that event, but I know we were one of the early ones that started that, and it's a huge tradition in our business, and it's been a massive tool for us. And the other part too is, I should say, despite it being a great event, there's times we have Q&A period at the end, and I can assure you that the questions that we get, they're not seated. Like we've had some real fastballs coming in terms of some of the questions we've had, and it's great. The investors realize really quickly that these are not seated questions. They're not fluffy questions sometimes, and that's great. It gives everybody the opportunity to have real dialogue, not prepared, and people feel a lot more comfortable about asking those questions in a large group.
Yeah. So back to so this is one of those things that when you showcase transparency, that builds trust. And like we always say, I'm like, high finance is about trust more than it is about transactions. And so I think establishing that trust, and from me as looking on from the outside in, I would say that probably had a lot to do with that rise from 600K to 900 million. So
I can't stress enough how I'll give you an example of that, Ryan. When we've set up our second fund, which is a secondary mezz fund, and that was because we saw some opportunities with maybe some additional risk tagged to it. I mean, obviously the yields are adjusted for that in terms of what our investors are getting back, but it was so interesting to see what happened. We had established such a track record with our existing investors that when we told our existing investors we were setting up a second fund that was higher risk, it was incredible how many investors, had a check ready and was like, hold on a sec here, guys, there's a process. We have to give you an offering memorandum. We've got to go through suitability. But it was incredible to see how many were, trusted us so much that I'm sure had we allowed them, they would have just given us a check. But I mean, clearly we had to go through the proper protocols, of course, then they had to, meet suitability, of course. But again, it comes back to the foundation of trust. It's huge.
Yeah, absolutely. And, operating a fund in Canada is no joke. This is why I decided not to. Now, I know yourself, a lot of people who are brave enough to face the regulatory terrain of Canadian finance, and it's fine. Like, we'll follow whatever rules that we're subject to, of course. But with 14 or 15 regulators across all the provinces, like my American friends were like, 14 or 15, we got the SEC. What the heck is going on up there? Yeah, 14 or 15 different regulators across provinces. How do you embed compliance as a foundation rather than overhead? Because this is a big job.
It's a big job, and the regulatory landscape in Canada, it continues to get more complex. And there's two ways you can really look at it. Right? Is you can look at compliance and regulation as a hindrance, or you can really think about it as a value add to protect investors and your customers. It's a good thing for everyone. It helps further develop trust at the end of the day. We keep coming back to trust, that getting alignment with regulation and your solution to providing to investors can be a really powerful combination. But nevertheless, it is an onerous task. It is something that requires a lot of investment. It requires a lot of oversight, especially as the CEO of the business is ultimately responsible for compliance within the organization. It's not something you can take lightly. And for our business, you're right. I can't remember. I think I have to double check. I can't remember even the count of how many regulators we have, but we've got a provincial regulator for each securities. A securities regulator for each province we operate in, as well as a lending regulator in each province that we lend in. And in addition to that, you've got AML, FinTrack. It's can be quite burdensome for sure. We really do try to think about compliance and regulation in our business as something that we can work complementary to our business. And our investors know that we're taking a leading position in that. It's not something that we're just trying to meet the bare minimum. Our investors realize and understand that we're setting the bar within the industry. And how do we do that? One of the things that we are really proud of is we work with several of the regulators on working committees on new policy that they're looking at establishing, not only to provide some input from industry on some of the pros and cons of what it is that they're trying to push forth, but also thinking that through the customer's eyes and lens of, does this truly actually help protect the consumer, and what are the pros and cons of what it is that's trying to be introduced? So we've really taken a leadership role there within our organization to try to help set that policy. I think it's good for our business, and it's been good for industry. And our investors and customers know that we're taking a leading role there. So there's a real opportunity for a business to not just comply, but also take part of that process.
Yeah, make it better for sure. So when it comes to trying to figure it out, especially the complexities in the regulatory environment that you operate in Canada, that you've got your hands full, are there any perhaps service providers or communities or anybody looking who's listening to Canada? Where can they go to kind of help get the right footing? Anyone you'd recommend?
Yeah, well, I would certainly advise not to do what we did when we first started out, which is bang your head against the desk and try to figure it all out ourselves. But through some experience, we leveraged that. Again, this is where advisory board was really helpful for us in helping us establish certain relationships and connections with consultants in a variety of different components of the regulatory regime, whether it was, the AML shop, anti-money laundering shop out of Toronto, which was hugely helpful for us in establishing a AML policy for both AML and FinTrack compliance. This was a huge feat, and we had to do it in a very short order on the lending side of our business, and they were really helpful. So a shout out to those guys. Those guys did a great job for our industry. I would definitely reach out to them with respect to that. I would also consider joining a variety of different industry associations. I know on the lending side of our business, we have CAMLA, or the Canadian Alternative Mortgage Lenders Association. Again, there's a variety of different businesses such as ourselves and other leaders, and even smaller businesses there that are really contributing to conversation and discussion around what are the challenges in the industry, whether internal or external. And again, people are really open to doing what's best for industry. It's not saying we're not competitors. We are competitors, and we duke it out on the street, and that's great. But we're all doing our best to make sure that it's a healthy landscape. The other part too is, and not to pump your tires too much here, Ryan, but listening to podcasts like this. I mean, what talk about a great resource for getting some information and listening to guests. I would throw that out there to all your guests. I mean, if there's anything that I can help with, or you think that's intriguing about what we talked about today, please reach out, and I'll share some more information at the end of the podcast. But please do reach out. Happy to be a resource.
Yeah, PHL Capital, Steve Ponte, absolutely, and we'll get that contact information at the end for sure. I'd love to talk about. So since we're talking about organizations and we're talking about service providers, I'd love to talk about just some of the systematic resilience, or some of the systems, the tech stack. Now, the favorite tool, as we all know, is Microsoft Excel. It's a great tool. How did you transition from Excel to scalable tech, and how has that enhanced that oversight and enabled you to future-proof your business?
Yeah, I mean, again, Excel is, I'm a big Excel fan, but at some point in time, and it works when you've got a $20 million fund, but when you've got a variety of different, in our business, you've got investors, you've got different asset classes on the lending side, whether it's residential, construction, development, land loans, draws. You've got multiple worksheet after worksheet after worksheet that are interconnected. It starts to become a liability when you think that one wrong, you press enter or minus somewhere by accident, all of a sudden you've got problems. So we've used a variety of different tools in our business on the lending side. We've gone through a group called Mortgage Automator, which is really a loan management system. That's been helpful not only with getting us a scalable foundation in which we can manage our mortgage loans, but it's also helped us with things like also on the regulatory component. So it checked a few boxes for us. Not only was it something more scalable than Excel that gives us much more granular and real-time data that we're able to access and make decisions from, which is hugely important in our business. Is how do you get timely, real-time data, and using more cutting-edge software. These folks on the lending side, Exempt Edge on our investor platform is huge as well. Not only has helped us just managing our information and data and making real-time decisions, it's also helped us from a regulatory and compliance perspective. You talk about finding some efficiencies. That was, using those types of, relying on tech and software has helped us really scale the business and helped us navigate through the regulatory framework that we're exposed to. So really important.
Yeah, absolutely. So your tech stack, would you say that was part of your ability to go from 600K to 900 million?
Absolutely. In fact, I'm not sure what the number was, Ryan, but probably when we got to 400 million, I would argue that our Excel, as good as it is and as intricate as it can be, went from an asset to a liability, and was something that we knew with every additional dollar that we raised and as our fund got larger, that was just fraught with risk. And we just needed to find a different solution. And thankfully we've been able to find that.
Yeah, brilliant. Yeah, I know tech, once you're able to keep up with the tech stack and really start dialing that in, I've had a lot of people, and myself included, it is a critical factor. And with AI and the rise of the machines, and soon we'll have our robot overlords. But until then, it's going to be a great scale tool for sure.
I mean, AI is, just another, that's a whole nother topic. AI is going to it's going to revolutionize a lot of businesses, but talk about scalability in our space in terms of lending and processing data. And it's going to be massive. The level of, it's not that we will lose bodies over it. I think about the many analysts that we have in our business, but these folks are going to be able to help with different things in our business going forward. But AI is going to be able to scrub the data that we have to provide real-time solutions and scenarios and analyses and sensitivity analysis in our business that is just going to make us that much sharper of a business. And, for those that are going to be stuck in the past that continue to be comfortable with just using Excel, they're going to get left in the dust, unfortunately.
Yeah, absolutely. I'd love to zoom out and just in the market right now. One thing I've noticed, and you and I spoke about this when we first met, I remember, is about how banks are starting to tighten a little bit, right? They're very selective on it's kind of a risk-off environment. At least that's how I'm sensing it. So with this risk-off environment that traditional banks are taking, all 5 of them, right? It's not a lot here, but they control it. How is PHL positioning itself just to meet the demands from both brokers and borrowers in the markets that you're in?
Yeah, great question. It's no secret when you think about banking in Canada. We've got some tremendous banks. We've got a very, very stable and strong financial system. We have very large banks in Canada that tend to follow, operate very similarly. I know they like to differentiate each other, but they do operate a lot the same. With every year that goes by, there's tightened credit policy, more rules, more compliance, and less common sense in lending. And as we know, financial markets and debt in this case requires very customized solutions in many cases for what people are looking for. This is why you're seeing the rise of the alts that we talked about, Ryan. And this is why you've got your podcast and why you're so popular. Is there's this whole segment of the market that's just emerging with a ton of force just because of this, because the large institutions are becoming, they're becoming too rigid, and it's opened up opportunities for companies like us, like PHL, to operate and provide solutions for customers. And you think about just the banking in Canada, like the mortgage market in Canada itself is, I don't have I think the last stat that I had was 2.5 trillion. It's probably more than that today. So when you think about our space managing 5% and growing in that space, it can be a huge market, and it will continue to grow. And I don't see that changing anytime soon. I think the banks consistently, and listen, this isn't a knock on the banks. We've got great relationships with the banks. They fill the void for 85 to 90% of the market, but that segment of the market that needs something more boutique and more bespoke and customized, whether it's they need funds quickly, they need funds for a shorter period of time, they just need alternatives. And we're providing that in this marketplace. And thankfully, it's a massive market in the U.S. and Canada is, I believe, we're at least 10 or 15 years behind where the U.S. is, and will be a space that continues to grow in Canada.
Man, you're not kidding. And how have you seen any changes in regulators or anything like that? Yeah,
I appreciate the regulators have a difficult task. In a market that continues to evolve, you've got social media, you've got, I'm not going to get too political here, but you've got scammers online, you've got the amount of fraud that's in the market today. It makes it very difficult for regulators to try to protect investors and also protect borrowers. And with that comes tightened policy, more rigidity. And unfortunately, it's kind of the throw the baby out with the bathwater kind of scenario where that, extended policy and procedures ultimately makes it difficult for customers to find solutions and good customers to find solutions. And we're going to continue to see this trend for the foreseeable future.
Yeah. Awesome. Well, that's good news for you, man. So given today's heightened regulatory and capital challenges, what would you say are some of those key success factors for structuring an MIC or mortgage investment corporation?
I think the key factors would be making sure that you understand all the stakeholders that are in the market today. So making sure that you've hired the appropriate professionals that understand compliance, they can get it right from the start, join industry associations, listen to podcasts like yourself, and really making sure that you understand both sides of the balance sheet in our case, as again, because we have investors and also investors that are providing the capital for our business, and then the borrowers in which we are deploying that capital to generate a return. really understanding both sides of the balance sheet there. When I say that, I mean understanding what solutions you're providing for both of those stakeholders. So for the borrowers, we're providing an alternate lending solution that they can't find from conventional banks and credit unions across Canada. And then obviously for the investors are looking for something they perceive to be safe, stable, and obviously providing a healthy risk-adjusted return. So I feel like the MIC space has really done a great job. We've got lots of great competitors as well, but groups like PHL have been able to find a nice balance that helps both of those stakeholders. And also, I think being clear on what it is that your borrowers and investors are looking for, and making sure you're not trying to provide solutions for everybody. Know what it is that you're trying to do, and stay focused on that.
Brilliant, man. So before we wrap things up, is there final thoughts? Is there ways people can reach out to if they want to learn more or anything at all?
Yeah. Feel free to reach out to us at Steve Ponte at phlcapital.com. I'm on LinkedIn. Check out our website. Happy to chat with anyone that's got any questions about our space, or if there's any consultants, et cetera, that people are interested in. Happy to share that information, or even our industry associations. Happy to connect you. And I really want to thank you, Ryan, for allowing me on the show. Again, huge fan, and I love what you're doing for finance guys like myself. My only beef is that I wish that this show was available 20 years ago. I probably would have saved myself a lot of stress over the years. So keep doing what you're doing, man. Really appreciate it.
Well, I appreciate it. And we've been very fortunate to be in the top, 2 or 3% in the world. And it's all because of amazing guests like you. So you're part of the Making Billions alum, man. So appreciate you, man. So just to summarize everything we talked about, build your advisory board, leverage their experience for you to compress decades into days. The second one is you got to nail it on compliance. And that's typically done with the right providers. Steve provided one of them that he likes, but make sure that however you do it, just make sure you do it. And finally, remember, finance, it's more about trust than it is about transactions. Don't be afraid to go on a listening tour. You do these things and you too will be well on your way in your pursuit of making billions.